CME Group launched Micro E-mini Futures Contracts. Discover how a smaller Micro E-mini Futures Contract opens the world to greater trading possibilities.
Welcome to Striking Options, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Bob Icino. Welcome, Bob.
Thanks for having me, Jeff.
Well, it's interesting, Bob. We're seeing the trade tariff escalation continue. Also, though, we have a lot of key data this week to digest. Where are you focused?
Well, pretty much on what you just said, but not only the trade tariffs themselves, but I'd like to see what all the different central bankers this week feel about the tariffs themselves, if they'll be honest about it.
No, that's a great point. And domestically here, we have a lot of Fed speak. We're seeing markets move based upon the fact that maybe we see some type of rate cut later in the year. But let's press pause on that. Let's get this first lightning round. Are you ready?
I'm ready.
Crude slips. We have seen crude break to the downside in its range, Bob. What are your thoughts on the crude oil patch?
Well, a couple of things. Number one, we've seen OPEC again reiterate that they're going to make up any sort of weakness in the price. So we're going to stay in that range, in my opinion. So the example I want to look at is selling the week 2 June $50 put for $810 and buying the 48 week 2 June put for $450 in crude oil.
This makes a lot of sense. So you're going to be selling this spread. It's going to allow an investor to collect potentially $360. But walk me through this $50 mark. It seems like that's kind of a buoyed, a little bit of a trend line, support line. Is that right?
Yeah, it is. I mean, the $50 is not only psychological, but it's a midpoint of the prior move. And then we've got some good resistance at about 48.50. So that spread really takes advantage of that sort of resistance and significant area on the support side.
That makes sense why you pick those select strikes. And remember, this put spread expires week 2. That's June 14th. But the underlying future contract was actually the July future. It was priced around 52.75, and the at-the-money vol 47.59. Talk a little bit about that at-the-money volatility, Bob.
Yeah, last point on this. This is the first time I've found, and I've gone all the way back to 2013, where crude oil vol has actually closed higher than it opened 9 consecutive days. Vol's basically doubled since May.
That's amazing. To see it back above 50, we haven't seen that in quite some time. Great point. And remember that these are trade examples, not trade recommendation. Let's move into the second lightning round, pal.
Let's do it.
Fed reacts. Well, we did see an absolute move lower in yields, which was jaw-dropping. Tell me about that move, Bob.
Yeah, 206 on the 10-year, and we've moved a little bit off of that level right now. The negative bent to the yield curve from 10-month to 3-month got as low as negative 25 basis points.
And just 4 weeks ago, we were near 2.60% in that 10-year futures contract. To see that type of move caught a lot of people off sides. Yes, we're seeing some capital flows into treasuries, but also some short covering. But it's interesting at this moment in time, we did see the Fed speak. Bullard came out and talked about insinuating that there could be a cut before another hike, and all of a sudden people are feeling better. Stock market is rallying. So my trade example, I think, is going to play to the other side of the yields moving back up, Bob.
Yeah, and the CME Fed Watch tool has actually moved toward a probability of a rate cut, not just in January of next year, but actually in December of this year, counting in about 2 rate cuts right now.
Well, that's remarkable. And the trade example I want to utilize into that scenario is buying the 126, 124, week 4. That's the end of the month, June 28th. That's the put spread I want to be a buyer in the 10-year note. It's going to give me some time to expand upon it. It's only going to cost me $305 to establish this position.
Yeah, and one thing I like about this example is buying the put spread. We talk a lot about taking advantage of volatility and selling, but the Treasury volatility is in a very tight range, even though it's elevated. There's some really good stuff on the CME Group website about how Treasury volatility may not act typically versus other markets.
No, that's right. Then the at-the-money volatility is at 5.11. So therefore, paying that premium in the event we do see the yields retrace up to 2.25, 230. This trade example will capture that. But remember, the SEP futures are the underlying. It was trading at 126.24 when this trade example was priced out, Bob.
Yeah, this is a really good example, and the treasuries are definitely overbought on the upside. Shrinking yields could pull back nicely.
And just to finalize this trade example, the maximum loss is 305, exactly what we're paying for this put spread. However, as we're looking and identified 2 full bond points, the maximum gain, if it fills in all the way, is about $1,695. So it's always important to remember that risk reward, Bob.
Yeah, again, looking at the treasuries is a good way to know that you have to know what the volatility characteristics are of a specific market.
Absolutely. Well, thanks as always for jumping on Striking Options, Bob. And please tune in every week as we will continue to strike options.